Hello and welcome to lesson 4 of our video tutorial series on the MT4 indicators. Here we will be discussing the Fibonacci retracement levels as a trading indicator. Before getting on with discussing how the Fibonacci retracement levels can be used as an indicator, let's understand what the Fibonacci number is and how these retracement levels were determined. Fibonacci is a mathematical sequence of numbers where every new number in the series is the sum of the preceding two numbers. The sequence thus becomes as shown: 0, 1, 1, 2, 3, 5, 8, 13 and so on. If you notice, here every number in the sequence is the sum of the previous two numbers. So while 3 is 1 plus 2, 5 is 2 plus 3, 13 is 5 plus 8, and so on. Fibonacci sequence also has a significant presence in explaining some of the various concepts in science, mathematics, nature, and art, and now also in trading. We will examine its use as a technical trade indicator. In trading, Fibonacci retracement levels are used as a technical tool for identifying the areas of support and resistances at key price levels. These key levels are also known as the Fibonacci retracement levels. The retracement levels are calculated using the set Fibonacci ratios of 23.6%, 38.2%, 50% retracement, 61.8% and 100%. The Fibonacci ratios, also known as the golden ratios, were determined based on their repetition in the Fibonacci sequence of numbers. The ratio of consecutive Fibonacci numbers was found to converge to these retracement levels of 23.6%, 38.2% and 61.2%. These are what we use in this indicator to calculate the price levels where the price value will most likely converge to or diverge from. So how are these golden ratios or the Fibonacci ratios determined? These ratios are found or calculated from the Fibonacci sequence itself. If you notice, the ratio of every number to the first number on its right in this sequence was found to be the same as 61.82%. This is one of the retracement levels that we use in this indicator. For example, 89 over 144 is 61.80. 55 over 89 also comes out to be equal to 61.82, and so on. Similarly, the ratio of each number in this sequence to the second number on its right was found to converge to 38.2%. This is another retracement level used in this indicator. For example, 21 over 55 converges to 38.2%. Similarly, 34 over 89 converges to 38.2%, and so on. And finally, the ratio of each number in the sequence to the third number on its right was found to converge to 23.6%. So 21 over 89 was somewhere around 23.595, which is almost equal to 23.6%. 34 over 144 was again found to be equal to 23.6%, and so on. So this is how, based on the ratios of each number in the Fibonacci sequence, the Fibonacci retracement levels were determined based on the repetition of the golden ratios or the Fibonacci ratios. Now that we know how the retracement levels are determined, we shall see how to apply these levels onto the chart. The Fibonacci retracement levels are created between two extreme points of a price range. The starting extreme point is set at 0%, and the second extreme point is the 100% level. The vertical distance between these two extreme points is then divided using the Fibonacci ratios of 23.6, 38.2, 50, and 61.8%. Horizontal lines are drawn at these levels to identify the areas of support and resistance. So we learned that the Fibonacci retracement levels help us identify the support and resistance levels. But what is a support or resistance? Support is a price level from where the price of a financial instrument bounces back up towards higher price values. It is a technical level the financial instrument tries to break below but fails to do so. On the other hand, resistance is the price level from where the price of a financial instrument slides back down towards lower price values. It is a technical level the financial instrument tries to break above but fails to do so. Once the Fibonacci retracement levels have been applied to the chart of the financial instrument you are trading, the retracement levels act either as the overhead resistance or the underlying support, depending upon the current price level of the instrument traded. As the price moves between any two given retracement levels, the level above the current price acts as the overhead resistance. This is the level where the trader would look to sell the instrument. And the level below the current market price acts as the underlying support. This is where the trader would look to buy the instrument being traded. Let's have a look at the trading platform on how this works. We consider the daily chart for pound dollar. Consider the price range from mid-June high of around 1.57506 to the lows of 1.48127 made in early July. Following this price decline, the price for pound yen had started retracing this fall, moving back up from the lows towards the high. Thus, if the price reaches back to the June high, it will be considered to have retraced the entire price range. Therefore, the high price would be the 100% retracement level, while the low price would be the 0% retracement level. Next, we apply the retracement levels of the indicator onto this price range between these two extreme points, taking the high point as the 100% retracement level and the low point as the 0% retracement level. On applying this, you can see that the entire price range has been divided into the other retracement levels as well. These horizontal lines that you see are at the 23.6%, 38.2%, 50 and 61.8% retracement levels. So when the price reaches the 38.2% retracement level, we say the price of the currency pair has retraced 38.2% of the price range. Now consider that the current market price is between the 50% and the 61.8% level. Here, the 50% level will act as the underlying support, while the 61.8% level will act as the overhead resistance. So a trader would consider buying the currency pair when it is close to the 50% level, with the immediate target at the 61.8 level price. Once the price reaches that 61.8% level, which was the overhead resistance, if the price is unable to breach that resistance level, the trader would consider selling the currency pair close to the 61.8 level. However, if the price breaches the overhead resistance from below, now this level would act as an underlying support and the 100% price level would become the overhead resistance. In this case, the trader would consider buying the currency pair as soon as the 61.8 level is breached and would consider selling it around 100% level. So this way, these retracement levels act as both underlying support and the overhead resistance. Well, this is all that we will be covering on this topic about the Fibonacci retracement levels. Thank you for taking the time to watch this video.